Breaking! Canadian authorities need to prepare themselves for potential bank runs in the future. This according to a recent report coming from the Howe Institute.
I gotta listen to people because of your
Indeed, the report argues that the manner in which Canadian banks protect themselves may no longer be adequate, as the failure of Silicon Bank last year, along with Credit Suisse, shows that Canada may need to find a firmer place for prudential regulation, which I think is an interesting point, as it's not just Silicon Valley Bank that has been showing some signs of problems. From TD having to pay millions in fines after its Treasury spoofing case, to TD's money laundering fines, to CIBC's accusation that banks are hoarding cash, leading to the Bank of Canada's ongoing to this day cash injections, though the central bank denies the hoarding. Clearly this year has shown the banks are not exactly functioning as intended.
We're in newspapers every week with this shit.
So what I want to do today is go over the report, take a look at some of the emerging trends as outlined by the Howe Institute, and then take a look at some of the options that Howe says could leave the banking system better protected. As we'll see today, this is an ongoing story in the Canadian banking system with a lot of remaining questions, but we will continue to track Canada's banks on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. Very briefly, what is it about the banking system that is so in need of urgent action? As even the report admits that Canada hasn't had any serious bank failures in years.
We'll give it time.
First, says the report, it's timing, in that bank runs can now happen in a matter of hours, which I think is a decent point. It's no longer like the days of It's a Wonderful Life, where wary depositors will line up outside the bank to withdraw their money. Rather, in the age of the internet, where everything is done online and information spreads quickly, deposit-taking institutions, the banks, can run out of money in short order. Second, says the report, deposit insurance, where the government guarantees all deposits that Canadians have at the banks up to $100,000, does not necessarily prevent bank runs. This was evidenced in 2017 when Home Capital in Canada underwent a partial bank run. Back then, Home Capital, the parent company of Home Trust, an alternative mortgage lender, after being accused of misleading investors, saw a partial run on deposits, leading to an almost $900 million worth of withdrawals within about 4 days, despite those deposits being guaranteed by the government. Further, says the report, even smaller banks, smaller deposit-taking institutions, can present a risk to the system if they all have problems at once. So, although Home Capital was not part of the Big Six banks, had we have seen major problems across all alternative lenders that could have presented a systemic risk. In the fourth problem, says C.D. Howe, and I'm sure viewers are going to love this one, it's getting more and more difficult to supervise the banks, with the line between leading and supervising a deposit-taking institution becoming increasingly blurred. Meaning, were the government to introduce more regulations on the banks that could blur the line between running the bank and supervising the bank, dampening incentives for innovation, which could make the banks less competitive.
We can't have that.
And the final problem, in an almost stark contrast, the public is getting sick of the banks not being regulated, with the report noting public tolerance for government agencies exercising judgment in the application of regulatory requirements is declining over time. Yeah, and the report goes on to note the declining public tolerance for the opaque exercise of judgment by public officials. Which, yeah, of course the public is getting a little fed up. Canadians seeing big profits during the pandemic with banks giving out risky loans like they were candy, only to see those loans followed up with headlines like this. And then there's constant news that the renewal cliff could tank the economy. Not to mention a Treasury spoofing scandal where the bank manipulated the Treasury market with fraudulent orders. You know, as we've all done by accident from time to time.
Don't call me.
In all of this, with nary a Canadian not fully believing that if the banks mess up, if the banks run into trouble, the central bank will 100% come to bail them out, which we'll get into that later. So, according to C.D. Howe, these are the big 5 emerging problems facing the banking system. Bank runs happen fast now. They can happen even if there's deposit insurance or not. They can happen to a lot of smaller banks, creating systemic problems. The government can't really overregulate without stifling innovation, and the public is sick of the government not regulating.
Impasse.
But what can we do about all these problems? For its part, the report seemingly cedes the point that bank runs are going to happen from time to time. As such, we need to focus on what we can do to make sure those bank runs don't morph into systemic panic. So I guess we're shooting for a more casual, friendly type of bank run. Regardless, the first option, says CD Howe, is to increase deposit insurance up to 100%, with the idea that if depositors knew that their funds were 100% guaranteed by the government, even if they were over 100,000, that would limit the incentive for bank runs. Further, it's not as though the leap to 100% guarantees would be that big. As argued in the footnote, Canada has already put in more protections for unsecured depositors vis-a-vis the bail-in regime, as in the event of a failure, the bank's senior debt, meaning its tradable bonds, would get absorbed before the bank absorbed deposits. And while the bail-in regime is beyond the scope of this video, suffice to say that under the regime, if a bank were to fail, there are much bigger fish, those buying the bank's bonds, that lose their shirts before the average depositor.
That is great to hear.
However, there is obviously some moral hazard problems with guaranteeing all deposits 100%. In that, if you know that the government is coming to the rescue regardless of where you decide to put your money, then there really isn't much incentive for the banks to act prudently to attract your deposits, as they obviously do right now. Regardless, the second option to manage those bank runs would be to require the banks to hold much more higher quality liquid assets on their books, meaning, I think, U.S. Treasuries. And if you just scoffed, as I did when reading it, the article's author was expecting that, as they noted in the footnote that the SVB failure is different than this suggestion, as Canadian regulations would require banks to revalue their treasuries as the market changed, and OSFI already mandates that banks mitigate interest rate risk, which wasn't the case with SVB.
Well, I'm convinced.
With that said, although requiring banks to hold on to more liquid assets, hold on to more cash may help in the case of a bank run, that would come at the cost and price of credit. Meaning, if banks have to hold on to more liquid assets or more cash, they may not be able to lend it out as cheaply to you when you want to buy a house.
It sure would be a shame if something happened.
Third, the report says we could redesign those liquidity requirements and, even more important, I think, expand the scope of the central bank's liquidity support, meaning expand the powers and the scope of the central bank's, the Bank of Canada's, cash injections into the system when needed.
Here we go.
And while the report goes into a few concerns about this, including the stigma brought on to the bank having to turn to the central bank for liquidity, the ability of the central bank to buy assets outright from the banks, etc., I don't think we need to go into this too much, as I think by now it's settled doctrine that in the case of emergency, the central bank will be turning on the printer. When SVB happened, when Silicon Valley Bank went down, I think everybody thought, well, the central bank is going to print, and of course print they did, and everything was fine, based on your definition of fine. So, allowing or pushing the central bank to set things straight when a bank run happens isn't exactly anything new. It would be more like codifying current practice, which, let's be clear, though far, far beyond the scope of this video, relying on the money printer to settle any and all problems has been tried over and over and over again throughout history and has never, not once, ever once worked out well.
But this time...
And finally, the fourth solution coming from the report would be the 100% backing of deposits by government-issued money, and the creation of new loans would only be done by the loaning out of that money, rather than the creation of new money as they currently do now. This would obviously end bank runs, as there wouldn't be any worry that your neighbor would get his money out of the bank before you did, as all of the money in the bank would be backed by government-issued funds. The report notes that this measure could help to ameliorate the boom and bust cycles brought on by credit expansion and credit destruction, eliminate bank runs, allow the government to issue money at zero interest rather than borrow at higher costs, and finally, since money wouldn't require the creation of debt, we'd see a major reduction in private and government-held debt. So this solution would really be the end of fractional reserve banking, with all deposits backed by the reserves held at the central bank. Banks would only be lending out money that they had on hand in the form of non-redeemable term deposits, money that can't be taken out at any time, and marketable debt like bonds, and bank capital. It's definitely an interesting idea, one that I was surprised to see come out of CD Howe. If you're looking for more information information on this, look up the Chicago plan, as this is not a new idea. It goes back to FDR. It's just a very, very difficult one to implement, which even C.D. Howe notes is probably too radical for most current stakeholders. So, in summary, to help ameliorate the systemic risk of bank runs, C.D. Howe says that we could increase deposit insurance to 100%, require the bank to hold more high-quality liquid assets, expand the scope of the central bank, and finally, 100% backing of deposits by government-issued money. And I wanted to undertake an in-depth review of this article, as reports from C.D. Howe have a way of ending up in policy. Recall the 2015 report from the think tank on Canadian mortgage debt, and how that at least partially contributed to the discussion surrounding the stress test. That report in 2015 came about as Canadians were taking on more and more mortgage debt, or at least what we thought at that time was more and more mortgage debt. This report is coming out as we're seeing the bank failures occur in the United States, and it mentions one near failure that we had here in Canada 7 years ago with Home Capital. I won't say near failure, but a near run.
Smart.
Yet, I still question as to why this report was needed in the first place. I don't think the C.D. Howe Institute got this out of thin air, and I don't mean to be hyperbolic whatsoever, but these do seem to be a lot of policy solutions searching for a problem. Home capital, obviously, yes, was a problem, but SVB in the United States, as the report even mentions, is protected against by certain regulations that we have here in Canada. I do think these are some plausible solutions for managing bank runs. My guess is we might increase deposit insurance, and of course, when push comes to shove, as we always have for the past 10-15 years, depend on the money printer. That's not a long-term solution, but such is the world right now.
And how?
Yet, even though this report offers some plausible solutions, I can't help but shaking the question of why. Are the banks about to see some increased regulation? Is there a problem with the banks that we don't know about? Again, I don't mean to be hyperbolic, it's not that type of channel. But a 32-page report is a lot of effort if meant only as a thought experiment. Whether or not any of these policy proposals do come to fruition remains to be seen, but we will obviously continue to track Canada's banking system on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.